The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Hi there, welcome one and all to another live webinar with us from Phillip Nova, and we have a very special guest from UOB Asset Management in the studio with us. Is none other than Edward Pye. He is part of the UOB AM's intermediary sales team, and he's responsible for external distribution relationships with the various intermediaries in Singapore. Edward has a demonstrated history of career in both the banking and fintech industry, starting his retail banking career in 2013 and later on pivoting his career towards technology-driven financial services corporations by providing cutting-edge technological solutions for multi-assets trading and currency information services. And what will be the topic of the day? It's none other than navigating inflation and volatility with income. As we know, 2022 started with global markets turning volatile in the first quarter due to risks over inflation, rising rates, and geopolitical risks in several parts of the world. And this uncertainty remains at elevated levels. And yeah, it's quite daunting as a investor when you think about the outlook, and there's so much uncertainty around. So amidst this backdrop, investors are likely to be seeking asset classes that provide both resiliency and income, and one asset that fits these requirements are REITs. And REITs are favored for their income potential, and they actually have a relatively low correlation to other asset classes, and this makes it a good diversification tool and a good hedge against inflation, especially so in the current market. At the same time, on the ESG front, where investors are becoming more conscious about what they're investing on, there is an expected increase in rents and capital gains for green buildings, giving rise to this very unique green investment opportunity that Edward is going to be walking us through about. Edward, if you're all set and ready to go, I'll hand the reins over to you very shortly. But first, let me ask the members of the audience, can you hear me loud and clear? If you can, type yes into the question box, which you can find on your control panel. It's somewhere at the bottom. Just type yes in there. so we know we're good to go. All right, Edward, if you're all set to go, I can give the reins over to you.
Okay, Ken, thanks, Sri, for the great introduction. Yeah, so I think just let me, firstly, thanks everyone for actually coming down, not coming down for me, logging in and actually, staying through your dinner time to, listen to what I have to actually offer from UOB Asset Management. As what Sri said, this year has been actually rather challenging because if you look at all the global markets, I think I don't even want to actually look at my own portfolio. Every time I look at it, it's actually kind of like red, and all you hardly see green. And I think with that background, clients has been actually looking for something more stable, a little bit more with the income, a little bit more with the resiliency as well. And of course, inflation has been a key headline today as well. So without further ado, maybe just kind of go through with you on the whole agenda of this today webinar. So today, let me okay, great. Yeah, so this will be the agenda. We'll be going through some of the inflation, current state of affairs, some of the macro fundamentals, what are the investment opportunities, the sustainability aspect as well, because I think there is a good investment opportunity there, and as well as the product that, the UB or the solution that the UBM actually has to provide all these opportunities. So maybe just a little bit about UOB Asset Management for those who have not actually maybe might not have heard of us before. We are the leading Asia-based asset manager with a headquarters in Singapore. Of course, from our establishment as a wholly owned subsidiary of UOB in 1986. I think what is remarkable is we have actually grown extensively across Asia with a presence in 9 markets, namely Malaysia, Brunei, Japan, Taiwan, Thailand, Indonesia, Vietnam, and of course we also have a joint venture with Ping An in China as well. Currently we have more than about 36 billion in assets in AUM, and servicing a wide range of clients, including various institutions and retail investors as well. We have an experienced team of more than about 90 over investment professionals who will conduct rigorous fundamental research within a proven investment framework to provide our clients with innovative investment solutions. So I think here at UBM, we are very committed to investing excellence. Now, our main vision is definitely to be a trusted asset manager in Asia, leading in both innovation and sustainability. I think to achieve this, we rely on all these 4 key pillars that you see, being at the forefront of the digital advancement, focusing on the sustainable investing or investments for both profit and purpose. We want to keep our customers at the center by providing a top-of-class investment solution and performance, and of course, finally, to embrace our Asian heritage and our regional expertise. And we are also, as to keep promise to our sustainability, aspect and pillar, we are a UN PRI signatory. So that means to say, what does that mean? It means we are actually required to fulfill several of the key obligations. We incorporate ESG issues into our investment analysis and decision-making process. We are an active owner in incorporate ESG consideration into the ownership policy and practices, and of course, we promote the acceptance and implementation of the principle within the investment industry. And throughout the years, we have also actually garnered accolades and awards across since 1986, and the consistency in our performance, of course, the testament to our strong Asian and global investment management capabilities. So I think with that, I know this is just a very brief introduction of UB Asset Management. Of course, if you would like to find out more about us, you can always visit our webpage. I think this is more or less what we want to really, get into it today, which is understanding inflation and the current states of affair. So I think one thing is that in the new headline we have always been seeing, if you look at Bloomberg, if you look at Straits Times, or if you look at any news outlet out there or the media, you will keep seeing all these headline inflation number, high inflation, and this inflation is actually spooking the market, causing economic pain. I think one thing that you can probably relate is, our COE prices has been actually increasing, and that has actually, the pain of inflation as well. I think the last Singapore headline inflation number is at about 7.5%. These are numbers that we have not seen for many years, and surprisingly, with the pent-up demand in the global market, and also the shock in the supply and the supply side, right? It has actually have done a lot of inflation accumulation, as well as also in the energy market. So we keep seeing all these kind of headline news, and I think inflation is definitely, if inflation is too high, is actually bad for the economy. In one of the cases in Venezuela in 2018, I think the inflation actually hit 1.3 million%, that is really out of the norm. It's really a whack. So the thing is, imagine your chicken rice having that 1.37 million% in inflation. How much will it cost? Can you still be able to actually afford to eat it? So what high inflation does is actually high inflation erodes your purchasing power, and one thing is, of course, because of high inflation, it actually results in a lot of social instability. So when you see high inflation numbers, which is really atrocious, you start to see a lot of protests, a lot of looting and all this on the news headline. And of course, the cost of business actually increases, and that actually results in slower economic activities as well, which that leads to severe recession and all this due to high inflation. So I think this is why a lot of what happens in the market, the central banks are basically trying to tame the inflation, that it doesn't actually go out of hand. So I think one thing is, maybe I just want to give kind of a brief primary objective of global central markets. So now I think the whole key role of central banks in the world is actually, or central banks around the world, is to actually conduct monetary policy to achieve price stability, your low and stable inflation, and to actually help manage economic fluctuation. So they actually play a very crucial role in ensuring economic and financial stability. So if you look at some of the targets that the Fed or the ECB or the BOJ, their price stability target is probably looking at about 2%, right? And for Fed, they actually aims 2% over the longer run. And the question is, why 2%, right? So I think typically that 2% range is optimal, because that actually provides a price stability. That means to say the central banks typically just target an annual rate of inflation, which is the 2%, believing that a slowly increasing price level keep businesses profitable, prevent consumer from waiting for lower prices before making purchases. And of course, there are some, in fact, who believe that the primary function of inflation itself is actually to prevent deflation as well. So I think too high of inflation is not good, but too low of inflation or a negative inflation, what we call deflation, is also not good. So we do want that kind of optimal, slow and steady kind of inflation, which will be good for all of us in terms of that will also, one thing is that because of inflation, every year you can also get a higher increase in your pay as well. Yeah, so this is all due to inflation. So some of the tools that government actually use to fight inflation are things like monetary policy. When you have, this is what is actually basically happening right now. You have higher inflation, they actually use higher interest rates to control the inflation. So higher interest rate actually increase the cost of borrowing, and I encourage people to actually save more. You have control of money supply. You have seen some of the central bank actually use this tool as well. So you have your higher bank reserve requirement, quantitative tightening, like the People Bank of China, they actually use some of the things like higher bank reserve requirement. You also have fiscal policy. higher income tax, to reduce spending and curb inflationary pressure. So these are some of the tools that the central banks around the world use to actually fight inflation and implement policies as well. So I think the one of the recent thing that we have seen is that we have of course seen interest rate hike across a lot of the market or the different countries. And now if we look at the US itself, the Fed actually raised the Federal Reserve rate by 75 basis points to about 3 to 3.25% range during this recent September meeting. That's the third straight 3/4 point increase, and pushing borrowing costs to the highest since 2008. So I think policymakers also anticipate that the ongoing increase in the target range will be appropriate, which is reinforced by the Fed chair Powell himself during the conference. I think he said that he has to actually get inflation behind us, and he also hoped that there's actually a painless way to do it, but in fact the actual fact is there isn't. So that's why with the high inflation, you have seen your rates increasing. That is actually causing kind of some turmoil in the financial markets as well. So I think some of the impacts of the rising interest rates, maybe if you look at like stocks in the equity asset class, I think it have negative impact on stocks. Of course, basically due to the increase in cost of borrowing, and of course with that, generally doing business, because of borrowing of doing business, and as well therefore eating into the profitability, and of course growth stocks tend to be impacted more, as their profitability actually get impacted more severely during a rising interest rate environment. And some of the impact on the bonds is that there's negative for existing bonds with longer maturity. So if you have seen the yield curve, if you look at it, the short-term yields curve is actually higher than the longer duration yield curve. So there's a yield curve inversion, and of course due to the decline in the relative attractiveness compared to new bond issuance, the bank deposit rates actually may actually pay a higher interest rate, and that's exactly what's happening right now, right? If you have seen you've seen the deposit rates coming up 3-4%. If you look at risk-free rates like your treasury T-bills and all this is about 3+%. So I think the corporate bonds definitely need to pay much higher and all this. So the relative attractiveness of all these corporate bonds and all this kind of actually reduces, because your risk-free rate is right now is actually quite at a high rate. And of course, even for REITs itself, that the asset class that we're going to touch on, I think it is impacted as well. So in short term, things REITs are your defensive asset class in nature. So during interest rate rises, it actually become less attractive. But I think this doesn't mean that investors should actually avoid investing in REITs during the rising interest rate environment, because I think one thing is in reality, interest rate risings are due to a strong underlying economy and inflationary activities. You have stronger rates fundamental may actually outweigh the negative impact caused by rising rates. So with your rising rate, I think one of the inflation hedge is also your uprise in the rental income as well. So just to actually kind of focus a little bit more on the REITs performance during and after Fed's fund rate as an antidote is that anecdote is that during the 1999 to 2000 period, when there was this rate cycle movement of about 175 basis point, I think the REITs they actually did offer a positive return, and after the cycle they actually did quite well as well. And in 04 to 06, it kind of repeat that whole performance, and also in 16 to 18 it did the same thing as well. So but I think one thing that I will probably want to actually mention is that if you look at the global markets performance chart today, of course you have your green, which is the Asia Pacific REIT index, and if you have the MSCI AC World Index, which is global equity, and of course you also have your global equity index, which is the bond index. And if you can see that if you compare the global equities to Asia Pacific, I think the Asia Pacific REITs actually perform a little bit better, even though it's in the negative range as well. And of course, if you can see that the whatever that's happening in the market today has impacted almost all the asset class because of high inflation. You have your quantitative tightening. You have your supply side shock, you have high energy prices, you also have geopolitical tension that actually, all this cocktail of events that is actually impacting the market itself. So some of the current macro fundamentals that probably maybe I just want to go through is basically if you still look at in terms of the real GDP growth consensus as of June 2022, I think one thing that we can see is that the forecast for 2022, where the opportunity is or where the GDP growth is probably in the Asia region as well compared to places like United States or Eurozone. So I think that's why today I think Asia Pacific or Asia region is a focus for us for all, right? So. And one thing is that inflation, yes, right now this year it tends to be a little bit stickier, but I think going forward is likely to moderate in 2023. So if you can see the inflation focus for 2023 is actually much lower compared to 2022, as maybe as things start to improve, and also things start to improve in terms of on the supply side as well, and all this will actually improve the inflation rate. So some of the things that we are seeing is also interest rate showing signs of picking as well. So the so-called dot plot show that interest rate will likely reach about 4 to about 4 or 4.4% by December itself, and of course rise to about 4.6, and then after that gradually it should actually come down as far as inflation start to actually kind of dwindle downwards. So in a nutshell, I think the investment conclusion is that we need to stay cautious because it is still a very uncertain environment. We do favor high quality defensive assets. Our view is that we probably lean towards a much soft landing view. The rising interest rate will of course continue to slow expansion, but I think some point of time bond yields may actually pay, creating of course also an opportunity in fixed income. I think the long term expected returns are of course will improve as things start to improve in terms of geopolitical risk, in terms of supply side improvement, and of course we continue to like alternatives such as real assets that can outperform in an inflationary environment such as your property or even REITs as well. Yeah, so I think with that, I probably would touch on the investment opportunities that is lying ahead. So I think one of the things is that if you look at just on the GDP growth number, Asia actually present one of the higher GDP growth numbers. So I think there is a rising opportunity in the Asia Pacific, especially on the Asia Pacific REITs, as of course economies reopen post COVID-19. You are seeing more and more nations opening up: Hong Kong, Japan, Korea, Taiwan. So I think Asia Pacific regions remain in a various phase of economic reopening. I mean, the level of reopening rates are different, but I think the general trend it is reopening, and that is actually poised to benefit from the post-COVID-19 economic growth. And of course, one thing that we also see is the overall tenant demand continues to see improvement across most sectors, and leasing momentum is of course expected to pick up. That is all in line with the reopening theme as well. And of course, growth is well underpinned by the cyclical uplift in rents. You have that normalization of economic activities, and an inflationary environment is also associated with economic growth. So it's generally favorable to the REIT sectors, like I've mentioned, in terms of the rental income growth and of course appreciation in asset capital values as well. So one thing is that in 2021, if you see in terms of REITs, I think it was a strong year, even for all the global REITs out there. Whereas in the APAC, I think Japan and Australia was actually leading compared to other Asian peers. And in the sectors, in most of the sectors, I think the gains are largely concentrated in industrial, retail, as well as residential REITs. So 2021 actually a strong year for REITs. But what is it in for 2022, right? So looking into this year itself, I think APAC REITs, like any of the other asset class, has actually have a tough start, and it's about down probably about 16%. I mean 14%. I think right now it's about 14-16%. However, it's still slightly better compared to the broader global markets, which is shown in the chart at the far right as well. Now the correction is definitely in tandem with the global markets itself. So what is actually pulling down for APAC REITs year to date is largely, you have a weak Australian REITs market, but I think the resiliency lie in the Hong Kong and in the SG markets that is actually has been relatively quite resilient. Yeah. So, and the thing is that even though this year has been a challenging year, if you look at REITs in terms of the long haul performance or the long term performance, I think APAC REITs outperformed the broader equity market over the long term. So APAC REIT actually delivered an annual rate of about 7+% versus 5 compared to the broader Asia Pacific equity market. So I think within equity itself, REITs of course look upon favorably as an asset class because it allows you to actually diversify beyond the standard sector allocation, and the risk profile of REITs itself differs greatly given that they are an equity with bond-like features, as you get your income through the dividend as well. So I think the next question is, okay, is it a good time to buy? I think if you look in terms of the valuation yardstick, if you look at the price book ratio, it is fairly supportive. You can see here that you can see the red line is actually the performance, and even though we have corrected about 18% from the peak on the valuation front, however, which is the blue line, we are trading at a cheaper level, almost at par value. Now I think this is actually so I think right now it's actually even lower than the par value, a little bit lower than below 1. So definitely, there should be limited downside from here, and definitely this is actually a good opportunity to actually buy in because your price to book value is almost at 1 or below 1, which is below your par value. And in terms of our outlooks, I think, where is the relative value? I think this is a snapshot of all our outlook for different segments across different geographical markets. And if you look at the left quadrant, right, the industrial REITs across different markets are concentrated at the peaking stage. Now, it's because the fundamentals are still very much intact for the industrial REITs. There's a continued tight demand and supply across the different markets. I think, however, during this peaking stage, typically, one have to take notice is that, your capital value and rent rises at a much slower pace, and then your rental growth might also be actually plateauing per se. So now if you look across on the bottom right quadrant, you have noticed that a lot of the other REITs are concentrated at the bottom. So for this stage, I think typical characteristics are that the capital values and the rents are declining at a much slower rate. Vacancy rates begin to peak and valuation discount narrow from here. So from here, it should actually move to the green side, the bottom left green quadrant, which is the rising stage to peak. We are positive on the retail REITs because the sector itself is on a recovery path, and we should see reduced rental waiver. We are also positive on the hospitality REITs because the sector is still poised to enjoy robust growth in the next 2 years or so. So all in all, I think we are looking at the APAC REITs, Asia Pacific REITs, to grow their DPU CAGR at about the clip of about 4.3% for the next 2 years, and we do expect, of course, growth to moderate going forward next year to about 3%, which is more in line with the longer term run rate. So with that, I think I probably can actually can summarize on the Asia Pacific. One thing is that for the Asia Pacific REITs, it's a good investment tool for regular income, right? So you have your upside potential like equity, you still have your dividend payouts, and of course the average forward dividend yield is at 4.3% for APAC REITs continue to remain attractive as well. I think another thing is that the sector valuation is attractive. Your price to book ratio I have mentioned is at par 1. Right now, I think year to date, I think it's a little bit shy of 1 as well. So definitely a good time, a good entry point for clients to go into. Dividend growth continues. I think expected to grow at a robust pace with 2 years DPU CAGR of 4.3. And the main focus basically is on the reopening trades, the reopening theme with structural growth drivers, and of course, your cyclical uplift in rents, as well as past asset acquisition to actually drive growth itself. So that is the whole, I think, the macro investment opportunity aspect of the Asia Pacific REITs. But one thing that we will also want to take note is that there is this aspect that we really need to focus on, which is actually the sustainability in Asia Pacific real estate. So the thing is that real estate itself, or building and construction, actually contribute to about 40% of the global CO2 emission. And by 2060, the global stock of building in the Asia Pacific region is actually, poised to double in terms of the building stock, and that is actually going to increase in the global CO2 emission. So there is a dire need for us to actually, have sustainability in the real estate region, especially in the Asia Pacific region. So I think, and that is also creating an investment opportunity for the investors out there. So sustainability matters in Asia Pacific real estate. Now, to reach the conclusion of sustainability matter, we have listed down the following 4 points, right? Climate change risk. You have your tightening climate regulation. There has been a raising awareness and demands, and of course, in the real estate sector, one way to go green is your green buildings, which actually provide benefits as well. So this is what I was actually talking about. Asian actually contribute significantly to CO2 emission, where the CO2 actually lead to higher climate change risk, higher frequency of extreme weather. So in your new headline, apart from the inflation and what's happening in the global financial market, you are also seeing a lot of the climate change stuff, where you see floods, drought, typhoon. There has been typhoon. There has tornadoes. Is always over the news, and the frequency of these happenings are actually increased as well. And like I've mentioned, real estate actually contribute 40% of the global CO2 emission as well, and the global building stock is actually to double in 2060. So there is that need for us to integrate sustainability, and that is going to actually create a positive feedback loop, because most of the countries, there has been tightening of carbon regulation across all different regions, in US, in Europe, in the Asia region as well. And most countries and region have actually announced new net zero commitments, and of course the commitments and the targets. So this is actually a positive signal against climate change, and we will foresee more coming. So some of the net zero commitment, like for example for Australia, they want to get net zero commitment by 2050. For Singapore, it's also 2050. Thailand 2065. So each and every country has their own net zero commitment. That means to say, in the long run, they have to achieve some kind of they have to achieve their commitment as well. They have to stick to their plan, and in the long run, that is actually going to create opportunity, especially on the sustainability front. So one thing is the decarbonization pathway is already starting. Of course, you have that very ambitious 1.5 degree Celsius decarbonization pathway. Now that's a very ambitious plan. Let's not look at anywhere else, but maybe our own, Singapore, right? So it is actually very urgent. The thing is that we just look at one area, which is hotel itself. I think in order for hotel to reach that, to play its part to reach that 1.5 degree decarbonization pathway by 2050, the hotels actually need to decrease your greenhouse gas emission, right, intensity by 99%. Now, that's 99% by 2050. That's a very hard thing to do, right? You need to put in a lot of effort from various stakeholders, from institutions, from governments, even from our own individual level as well. That's for 1.5 degree. Okay, let's say if we take a step back and go for the 2 degrees Celsius decarbonization pathway, that is not easy either, right? So what happened is that will actually, and we look at the same hotel example, right? The hotels, they actually need to decrease by 90% of the greenhouse gas emission. So even at 2 degrees, hotels need to work towards 90. 1.5 is at 99. So I think it is definitely challenging, but it is the right step to take. And sustainability, and one thing that I want to say is that sustainability in real estate is inevitable and urgent. So you will see more opportunities, especially in the green building areas. So one of the things that we have also seen is that we have seen strong year-on-year ESG, environmental, social, and governance fund inflow into global and ESG funds, accounting for more than, the percentage increase has been more of all funds inflow. If you look at globally from 2019 to 2020, it has actually grown more than 2x, and then in 2021 it has actually grown even more. But I think in Asia, there is even a higher growth potential, right? Because in Asia, there's a lot more things that we have to do infrastructurally, the things, the framework and all this. So that will actually increase an even higher growth potential if you compare to a global scale or global ESG fund inflow. That's why Asia itself present a lot of opportunity for sustainable fund itself. I think one thing is that maybe throughout the whole of this presentation, the only number that you truly need to remember is USD 17.8 trillion in US dollar. That is a magical number for today. Now that is the projected investment opportunity that green buildings are going to create in Asia by 2030, because there's an urgent need, right? Because we want to work towards their decarbonization pathway. We have countries have commitment to meet, and given that building and construction contribute so much to the CO2 emission, I think the investment opportunity for green building by 2020 is phenomenal. And of course, Asia Pacific region is also highest among the rest of the geographical areas as well. So one of the things is that there has been raising awareness and demands on sustainability as well. I think government, they themselves are catalyzing the adoption of sustainability practices, and major corporates throughout the world are also reassessing their business strategy to meet their sustainable targets and go just like your country level as well. And the world is also waking up to the investment opportunity that this brings. So in a recent survey on the sustainability, sustainable real estate done by a global commercial real estate company, Jones Lang LaSalle, which is JLL, they found that sustainability is the third consideration for occupiers, and 7 out of 10 are now willing to pay a rental premium to lease green buildings in the future, right? And the adoption of net zero carbon is also set to double in Asia Pacific by 2025. That is very true. And also 72% of investors believe that the green certification of buildings, right, actually drive a higher occupancy, higher rents, higher tenant retention, and of course, overall a higher value to the asset. Now, why is that so? So if you look at green buildings, green building basically why are they of a higher value and of a lower risk asset, right? Because green building itself, they have a much more efficient use of energy and water. There are pollution and waste reduction measures in place. Of course, they also enable recycling and reuse as well. There have also been environment consideration in construction and operation. So with that along, green building not only provide the tangible benefit, it also provide intangible benefits in the sense that tenants they themselves actually experience better air quality. With that, they actually have better health. And green buildings, they also have air systems that can effectively filter out most virus-sized particles. So with all these things, they actually lead into higher value. So how much higher value? Up to 30%, 31% higher value premium and faster sale. And in terms of the rental income as well, if you compare to the normal building, it's about 8% higher rental income. And even though with all these technologies and all this, the thing is, because of the efficiency use of energy, in the long run, they actually provide lower costs to the tenant. So you have about up to 12% in additional savings of cost. Also, significant decrease in the operational costs as well. And of course, with that, you have better quality with higher property occupancy rates, and of course, better management of workplace health and safety. So I think in terms of the greening of the real estate sector, the APAC green REITs itself actually provide an attractive opportunity in current environment. So of course, the opportunity from the growth in Asia Pacific REITs, one thing is there has been a lot of increase in awareness and focus on sustainability. And one thing that which is you've seen from the survey itself, occupiers today are willing to pay for green buildings. They are willing to pay that green premium, and of course that allows you to actually create key investment opportunities in the Asia Pacific. With that, looking at all these different opportunities and all, we actually launched our UOB APAC Green REITs ETF last year in November. Now this is the world first APAC Green REITs Green Real Estate Investment Trust or Green REITs ETF. Now the index that the ETF is tracking is basically developed by SGX as part of the SGX product suite in collaboration with UOB AM. Now the ETF aim is to actually contribute to the greening of the real estate sector. Of course, the main strong focus is on the Asia Pacific, and this ETF itself, we had an initial seeding from our parent company, UOB, and of course, we aims for quarterly distribution and of course provide the positive green impact. So the ETF itself tracks the IH UOB APAC Yield Focus Green REITs Index. Now the index is comprised of a basket of 50 REITs, which deliver high dividend yield to investors by investing in Asia Pacific, including Japan, and focus on green REITs, which are identified by a high ESG quality assessment. So the ESG, how we actually assess is we actually use GRESB real estate assessment. So one thing is, who is GRESB, right? So GRESB is actually a mission-driven and investor-led organization. They do provide standardized and validated ESG data to the capital markets. Now, they have been established since 2009, and they have become the leading ESG benchmark for real estate and infrastructure investment across the world. And by 2021 itself, GRESB is actually widely used by more than 120 institutional investors with over 28 trillion in AUM, 28 trillion US dollars in AUM. And the thing is that GRESB conduct comprehensive and robust assessment. So of course, the scores goes above beyond the qualitative assessment and is developed from a robust quantitative assessment of what is meant to be a green REITs, such as looking at factors such as like greenhouse gas emission, water, waste, and building certification. And of course, the GRESB score we use here is actually used in the green tilting for the index construction, which I will actually come to it in the next slide. So in terms of the index construction process, I'll just briefly touch on it. I think one thing that everyone should take note is that our index is actually rebalanced on a semi-annual basis in March and September. So, in the starting universe, there'll be about 270 over APAC REITs. And like most index construction process, the REITs will definitely be filtered for eligibility to pass the threshold of liquidity and free float market cap. However, one thing that we actually implement over here is the dividend yield trap. So what is dividend yield trap? So dividend yield trap basically means that we will exclude REITs, which have announced very promising dividend payouts, but when you look at their performance, actually fall lagged comparing to their peers. As we think, such REITs may not deliver the dividend as promised. So by adopting this dividend yield trap filtering, we actually do further secure our investors' profit and avoid investing in poor quality REITs as well. So of course, after that eligibility screen and all, we actually use GRESB scores to actually further optimize, and from there, I think the main thing that I want to actually highlight is the green tilting. Which is here. So basically, what we do is using the GRESB score that we actually got from the assessment, we actually reward REITs with REITs which are greener with higher weightage in the index itself. So if your REITs is actually much greener, you have a higher weightage in the index itself. So we do rewards green. We will do rewards REITs which are green. So that is where the green tilting comes about. And Of course, if you look in terms of the, then, you'll be asking me, yeah, it looks good and all in terms of all this ESG, but how about the performance? Of course, in terms of the performance itself, I think like what I've mentioned earlier, it has been quite tandem with the global markets. It has been impacted. But if you compare our green REITs index to the Asia Pacific REITs index, which is just the benchmark index, you can tell that the year-to-date performance, the green REITs index is actually a better performing one. So green REITs index versus a non-green REIT index, the performance is actually a little bit better. So in terms of the global market comparison, it actually proves that point as well. Yeah, so this is how we actually try and deliver profit, and of course, the fund actually aim for quarterly income distribution as mentioned. That is on the profit side. Another interesting point is that we have this thing for this ETF itself, a green impact measurement. So we actually do measure in terms of these four different aspects: greenhouse gas emission, energy consumption, your water consumption, your green building certification. So I'm just not going to go through all, but I think one thing is that, probably I just want to highlight with that 7% improvement in greenhouse gas emission, right, is actually equivalent to reducing greenhouse gas emission from about 2,000 home energy use for a year, and the 9%, lower of water consumption mean that you are saving water, which can fill 50 over Olympic-sized swimming pool. So these are just to put in layman term perspective, but we do measure the green impact, by having that green REITs investing, and also we do measure the ESG aspect of it. So these are the top 10 constituents of the ETF itself. And one thing that I probably won't go through all, but maybe I just want to highlight on the one of the constituents, which is DEXs. Now, DEXs manage and create a high quality workplace, across office and industrial and retail and healthcare sectors across Australia. They have an AUM of about 40 over billion, and they're also one of the top 50 entity on Australia's stock exchange. I think one thing that we want to highlight is on the sustainability aspect. Now, it shows that, how it performs in terms of the four different metrics that I've mentioned. So I think in 2021, DEXs actually achieved 56% reduction in, carbon emission using 2008 as a baseline. And of course, you also have your various like water consumption, energy consumption, and all this. But I think one thing is that I just want to highlight is that they actually, in May 2020 itself, they actually completed one of Australia's largest car park solar project at Willow Shopping Centre. And the project actually includes, nearly 5,000 solar PV panels that generate nearly up to, 2,500 megawatts per annum, which is actually the equivalent usage of 370 Queensland household. So by picking up this example, every of the constituents that you see inside, they actually have that, initiative, a very detailed plans on how they want to actually go sustainable, or how, how they want to go, or how they are already achieving. So that is the key similarities that you actually see in all the constituents in the index itself. Yeah. So with that, this is the key. Just give me one moment. Yeah, this is the key characteristics of the ETF. This is the sector location as well as the country location, and then you have the some of the details of the ETF itself. With that, I'll probably come to the end of my presentation. I hope you have are able to take in that amount of information. It's quite a bit, I understand. So the key magic number today is USD 17.8 trillion US dollar, and of course, you can scan this QR code to actually access the microsite that we have on our UOBAM webpage. It will link you to our APAC Green REITs ETF microsite, where you can actually find more details on it. So I'll just leave it here for a couple of minutes for clients, for participants to actually scan and access and view into our microsite of the ETF. Yep. Okay.
Yeah, but thank you so much for the sharing. We're going to jump into the Q&A session right now. Members of the audience, if you have questions for Edward and you would like him to address your queries on this wonderful new product which he shared with us about. Basically, it's green, it's a REIT, it gives you income generation. If you have questions on the product, please type them into the question box right now, and Edward will be here to address the query. Edward, while we're waiting for some of the questions from the members of our audience, can I just say, based on what you've shared today, what would be the top three takeaways that you want the audience to have?
I think the key, thanks for that. I think the key takeaway is that, even though in the short term period, right, there has been a lot of volatility in the market. 2022 has definitely been challenging for all of us in terms of a lot of the asset class as well. But I think, in within that chaos and volatility, there are pockets of opportunity. One thing is, of course, in terms of the APAC REITs, REITs being, like an equity class, but, bond-like features, they give you the dividend. So in this current period, some kind of income is actually good in terms of your passive income, to supplement whatever things that you need, or this passive income can be actually used to, reinvest and so on and so forth. But another point is that there is also an opportunity for capital appreciation. If you look at the price book ratio, looking at par value, that means to say, there is a good once market rebound and all this, that will actually probably take into that capital appreciation that will actually aid in your return as well. And of course, like how I say, it's a long-term investment approach in the sense that, the greening of the real estate sector in Asia Pacific, that USD 17.8 trillion in number is actually a phenomenal, huge number. Today is the opportunity for you to actually get into that, get into the investment opportunity that we actually bring to you. So I think that is the key takeaway. ESG is not going to go away. It's here to stay. Market volatility in the short term is definitely here to stay as well. Inflation, but I think there are also promising factors along the way where inflation will peak and moderate downwards in the coming year, and with that the interest rate will actually also kind of peak and come down as well. Yeah.
Hey, Edward, I think this is a question that you may get all the time.
Yeah.
Like, how different is this REIT versus other REITs that we are commonly more familiar with, for example, S REITs or Hong Kong REITs? How is it different? How would you explain that?
Okay, I think that is a very good question. So of course, I think as Singaporeans, we are very familiar with the whole S-REITs, what do you call that? Every S-REITs environment, right? Of course, I think one thing is about looking beyond S-REITs. The APAC Green REIT ETF actually provides you the diversification across the Asia Pacific region. I think while Singapore REITs enjoy a good standing among investors, the REITs market such as Japan and Australia offer breadth and depth. There's a diverse range of different REITs types beyond commercial REITs or office or retail assets. For instance, the residential REITs or the rental housing is a segment which is not available in the Singapore domestic market. The residential REITs typically enjoy stable rental income owing to high occupancy rate and a longer lease tenure. So similarly, investors are able to gain exposure to alternative or what we call a niche real estate assets, such as one thing maybe we can look at is the self-storage properties. You have early learning centers, to name a few as well. So to elaborate further, the self-storage REITs have a shorter lease to expiry as compared to other REITs asset type, and is thus well positioned to, of course, enjoy rental growth in tandem with the rise in the inflation. So we believe that casting the net over a wider APAC investment universe is a good portfolio diversification, and also because different real estate property types actually react differently in each market cycle. And of course, this should ultimately lower the overall volatility of the portfolio as well. Yeah, so I think that is the key main difference that I'll probably say, diversification, as well as also the opportunity into some of the REITs that that the the Singapore market doesn't actually offer. Yeah.
Members of the audience, this was Edward Pai from UOB Asset Management. We still have time with Edward to address any questions that you may have on the APAC Green REIT. To ask questions, just go to your control panel, and somewhere at the bottom you see a questions tab. You can type your questions in there. In the meantime, I'm just going to ask Edward some questions that I may have. Edward, you mentioned that this REIT was started not too long ago in later half of 2021. Hope you can still hear me.
In November.
Edward.
Yeah.
And since then, and you mentioned that when you're walking us through the prospectus of the REIT, you mentioned that this is a REIT that aims to generate income on a quarterly basis for their customers. So, how has the income generation been performing for this REIT? I think that's a question that many customers will want to know.
Of course. I think we are targeting about 4% in dividend for this REIT itself. So we have been sticking to it. That's because today the APAC REITs every forward dividend yield is about 4.3%, which is relatively attractive. So we want our dividends to be in the sustainable rate. That's why we're actually giving it about 4%. And I think with what is actually all being priced in, it will continue to be attractive itself. So I think on the SJ Group side itself, there are declaration of the dividends that we have actually given out to our clients. If I'm not wrong, we have actually given out twice already. Yeah. And of course, with this current environment of inflation and all, some kind of dividend yield is always helpful for investors as well.
Well, you mentioned that in the coming quarters or periods, APAC, I mean also from a climate change perspective, APAC is going to be focusing very much on being greener. And these REITs could be even more rosier in the months to come. Would you be able to explain how climate change is driving attractiveness for this product? Like, why is it affecting? I mean, it's a country goal. Why would it help to make this product even more attractive in the months to come?
Okay, I think not only in the month's time is just as you are speaking, things are already changing on the ground. So one thing is that in terms of the climate change, fighting the climate change, ESG, it has been more of a very top-down approach, right, from governments. You see, even MAS, they actually came out with some ESG framework that we need to adhere to as investment managers. We have ESG framework and regulation in the US and Europe. They are pretty much advanced, and in the Asia region, that is also coming up. That's because we all know that there is a need for us to actually fight the climate change, and not only that, because of the top-down approach where government comes to institutions are also implying and applying this ESG framework within their own internally as well. And because of all this, there has been a great education on ESG to the public as well. And right now we are seeing a lot of rising awareness from the ground as well. So from the bottom-up approach, we are seeing responses as well. So with that, clients are asking, hey, is your fund ESG? Is that ESG and that? So it has become a very common question. And one thing that I would actually highlight is that, clients or tenants are actually willing to pay for that higher green premium. So today, example, when you have an MNC, I can't name which, but if an MNC actually come today and they want to actually rent out a building or a space, they will actually first thing they will ask is your building ESG? So if it's ESG or if it's not ESG, they probably will not look into it, because it's also part of their mandate that they have to look for things that are ESG and all this kind of thing, even in finding rental places. So if it's ESG, there is a green premium there's a higher premium, or what we call green premium, that they are willing to pay, and that actually result in a higher rental income as well, and compared to a non-green building itself. So with that, the green buildings actually become more attractive. And of course, not only that, you not only have the tangible benefits that I mentioned. Another thing itself, there's also intangible benefits in terms of your healthcare of your employee and all this. So it has become very inclusive as well. And also green buildings, even though you pay the green premium, in the long run, because of the efficient energy usage, right, the companies actually has much more savings in terms of their operational costs. Yeah.
Hey, Edward, just one last question.
Yeah.
One key criticism about ESG products will be like, is a certification or the body that reviews the ESG product to assess whether it's green or not. And then you have I don't want to name firms as well, but there are some companies where it is green, but then there's some conflicting reports which state that this company is not so green, right? So how does the GRESB rank? I mean, like just to remind us once again, why is this a very very clear authority? When they give their opinions on how green the product is something that we should take note of.
I think one thing is because GRESB itself, they are the leading, leading guys in this area as well. Just give me one moment. Let me see whether I still can flash my screen on the GRESB. Just one.
Yeah, I think you should be able to.
Yeah, let me see. Okay, let me try and share, right? Are you able to see my screen?
Yes, yes.
Okay, great. So I think one thing is that, GRESB itself, they are one of the leading ESG benchmark. They have been since 2009, and not only that, because of their reputable, because of their reputation in this itself, they have been widely used by more than 120 institutional investors. So, and then they are actually benchmarked for real estate and infrastructure investment as well. So, in some of the ESG benchmark and frameworks and all this, or data provider, things like your Moody's and all these are also reputable. So they are equivalent of that in terms of the real estate and infrastructure. Not only that, I think one thing is that the concern of what you have mentioned about some companies are not that green and some companies are green and all, what we call greenwashing is actually very evident in the ESG space. But I think one thing that we have to take note is that there has been tightening ESG regulations across everywhere in US and Europe, even in Singapore as well. MES came up with a framework. So that means to say, right, you can nowadays, because of all these tough regulation, you are not just you can't just say that, oh, I'm ESG and that's about it. No, you really have to prove that you're ESG. There are frameworks to follow, there are regulations to follow, and if you meet certain strict criteria, then you will be actually deemed as ESG. So that's actually helpful in terms of retail investors like us. You have such established frameworks to actually prevent from all these companies from going for greenwashing itself. So I would say that in terms of the regulation wise, they are moving in the right direction, and leading organizations like GRESB will actually play more of such role in the future as well, because they has been a trusted source of a provider as well throughout the years. So in that sense, I think from governments coming in, institution with such data provider in terms of ESG data, I think all these plays in tandem and integration into providing a very much eliminating that greenwashing itself. So that is actually good for the retail investors out there.
All right, thank you so much for your insights and sharing, Edward. And members of the audience, if you still have more questions for Edward, and if you still have queries on the product that Edward talked us through today, you can send your questions in the survey form right at the end of the webinar, and we will have Edward look at them and address them so we can send the responses to you in our follow-up email tomorrow. This webinar is recorded, so you can review what was covered today through a webinar recording, and you will be able to go through what was covered today as well. Until our next webinar, thank you so much for being a wonderful audience, and do look out for our follow-up email tomorrow. Meanwhile, take care and stay safe. Thank you, Edward.
Thanks. Bye.
Bye-bye.